All right, welcome to the Everyday Investor, Michael Salvatico. How are you?
Oh, very good. Thank you, Darcy. It's a pleasure to be here.
This was the only meeting you had on all day, right?
Oh, this is certainly an important one. So
Yeah,
a real
that's good.
pleasure to be here and to meet you in person.
Yeah, no, that's great. Can you describe to our audience like who you are? I know you're head of ESG business development with S&P. Can you flesh that out a little bit more for me?
Yeah, definitely. So, my role at S&P Global is to head up the ESG solutions, responsible for Asia Pacific, Middle East, and Africa. So, for starters, let's think about the geography. It's pretty much everywhere from New Zealand. This is about as far east as I go, all the way to Turkey, traveling across
Wow.
Asia Pacific, Middle East, and the Africa region.
Okay, so take me back to a time when your role didn't exist.
Sustainability is a relatively new role.
Yeah.
It sounds surprising to say that now, especially given the amount of resources and efforts that that have been invested in, that companies have,
Yeah.
the larger companies have, to help understand, to measure, manage, and report on sustainability. Today is a very different world from where it was 20 years ago. The focus on sustainability, the origins of it, I suppose, if you think about it that way, really came from an ethical investment basis, values investing, excluding certain activities, and that you can take back 100 years.
Right.
Right,
Okay.
so there's been this niche area of sustainability, and I suppose this really comes down to what is sustainability nowadays too, because it represents more than just that ethical investment lens. But we certainly saw a lot of interest in sustainable investing, during periods of time where companies were under greater scrutiny for their behaviour, and there's examples that go back to the 70s where there's been activists who focused
Mm.
on certain behavior or involvement of companies in particular areas. But really, this area has grown in the last 20 years. It's 20 years ago that organizations like TrueCost or Robeco SAM ESG scores came to life. They were started by founders who were visionary at the time, and those founders, for instance, in the TrueCost space, said, we need to be more aware of what companies are doing when it comes to climate change related issues, when it comes to environmental issues. Because essentially, you've got a company, the construct of a company exists as a separate entity that is devised to create a benefit. And that benefit's focus was really on financial benefit for a long time. But if you've got a separate entity, the way I see it is they're essentially a corporate. They're a corporate that needs to behave like an individual would behave, right? With the same responsibilities, the separate entity, but still needing to be a good corporate entity. And so the expectation grew from the ground up that companies need to understand their impact on the environment, on society. They need to understand and look after their employees. They need to be aware of issues like their impact on climate change, on biodiversity and nature risk now under the lens. And so this is where the area of sustainability grew into the financially relevant, or let's say data rich area that it is today. And finance is focused on how to quantify metrics, right? Hundreds of years of quantifying financial metrics. Now, over the last 20 years, we've really gotten to the stage where we can quantify sustainability metrics. What sustainability looked like before the availability of this data and analytics, it was individual efforts, it was activists.
Mm.
Nowadays, the financial data that's available is robust financial and sustainability analysis on companies that's improving the information that an investor or an index provider such as S&P Global has to construct indices that provide themes, allowing access to your audience to particular themes within sustainability.
So let's say I decide to form a company, and traditionally the main purpose of that company is to generate a profit to distribute to the shareholders. That's kind of one dimensional, like what you're implying. That's I guess pure capitalism.
Mm-hmm.
Enter in stakeholder capitalism, I guess you could call it, where we're trying to program that corporate entity with a set of values, right? We're trying to create a governance structure perhaps, and a set of rules, like an algorithm. You're programming that company to behave as if it was a human, but a human that we all agree on is the right type of human, right? We're trying to program a set of values that we potentially all agree on. Is that a good way of describing that? And if so, is that what role S&P kind of plays, is helping with the programming of that entity?
Mm. If you think about what a company is, and certainly a listed company or a large private company, um, they have a board, and that board is responsible. Its best interests lie in the company, and their focus is on the sustainability of that company. Right. And sustainability in terms of financial sustainability, liquidity of that company, right?
Mm.
As much as it is nowadays on sustainable issues such as health and safety. Health and safety is an ESG issue. It's captured in our social pillar, right? And that might be a surprise to some people. Well, of course, every company is concerned about the health and safety of their employees. Well, some do it much better than others. Some have the policies and procedures in place to ensure the safety of their workforce. Some have demonstrated strong performance, reducing fatalities, reducing injuries. These are the ESG issues that we measure companies on nowadays. Cybersecurity.
Yeah.
Cybersecurity is an ESG issue because it's an issue that's dealing with the data and privacy issues of the consumers of company goods, and that data being stolen. Right. So these are some of the issues that we're dealing with, issues that are already, if you like, already part of the agenda of boards. They're probably sitting in a board's risk matrix of what they need to be focused on. If we add to that, the responsibilities of a board, for instance, include the long-term performance. What's the strategy of the company? If you're looking out and you're looking, 3 years, 5 years, you're concerned about hiring the right people. Have you got the right structure, the right policies to build on the human capital skills that you have in your organization to retain talent? And then we add to that other issues around climate change, which should also be on the agenda of a company 3 to 5 years out. And when I say should also, if you're sitting at the top of a company representing your shareholders as a board member, there's a need to take into account things that are going to affect that company in the future, in that short-term future. And if we look at the science on climate change, the message is clear. Climate change is leading to a greater frequency and intensity of hazards such as storms. And that's really close to my experience here in New Zealand as well. Having, I was expected to come out here the previous time on the 14th of Feb, and I couldn't make that trip
Right.
because of
Yeah.
the hurricane. So
Yeah.
if you're sitting in a company, then you should be aware of these things. Just like if you're investing in a company, you would hope that that company's taking these things into account. And if you're investing through an investment strategy, you would hope that that investment manager,
Yeah.
is taking these things into account.
Yeah. Are we expecting too much of companies to do some of this heavy lifting? And aren't we talking about the role of regulators rather than the role of service providers to investment managers?
That's a good way to think about it. So, are we asking a lot of companies to provide this information? So, yeah, well, we work with companies. We understand, what's involved when companies are doing their analysis on climate change, for instance, or doing their analysis on their ESG profile, as another example that we could dig into. But if we think about how we work with companies on one area, climate change, because I think that's a topic that's important and relevant to everybody.
Yeah.
Then it's a matter of companies being transparent. It's a matter of if you're investing a dollar in a company, you want to know what that company is doing. You want to know where that company sits today. Where are they right at this moment? And that's what we call a baseline assessment. This is where my climate position is in terms of your emissions profile. And we say emissions profile, I'm thinking about how the carbon emissions, or better put, what carbon emissions that company is responsible for. Okay, because the reason I hone in on carbon emissions is going back to the science. The science says that it's man-made carbon emissions that are leading to global warming, which is changing our planet, right? And that comes back to one of the quotes that I think really sums it up from the World Economic Forum: business as usual is making the planet unlivable. Okay, so there's the focus on climate change, the link back to a company disclosing carbon emissions. The thing is, once a company discloses carbon emissions, we actually need to know more. We need to know more than that indicator, which is, well, that's what they did. That's a backward-looking indicator, if you like. More important as an investor, or certainly as a person who's interested in a company, I'm talking here from an individual perspective, is I want to know what they're going to do. I want to know what their plan is. And this is where the strategy of that organization becomes really important. What goals have they got? What are they targeting to do with those emissions? And how are they going to do that over the next 3 to 5 years? Because we've only got a short amount of time to deal with this issue of climate change and carbon emissions. Rather than being a burden on the company, it's helping the company itself understand its own exposure to these issues, which are very important.
So like a risk management strategy is what you're basically saying.
It's risk management.
What is the ultimate objective here from an investor's perspective? So from an investor's perspective, I'm going to look at this just a little bit cynically and go, well, that sounds expensive. I'm either going to be paying more in fees or I'm going to get lower performance. Kind of the same thing.
I often think about this as well. Sustainability research isn't the only research that investors are subscribing to. They subscribe to enormous amounts of research if they want to be informed, right? Perhaps they're not. Maybe they're just Googling this stuff, in which case, each to their own, right? Yeah. The concern here is if somebody is just Googling information rather than relying on credible data sources that have gathered information which is likely to be beneficial to them, then how are they confident in the credibility of their due diligence? Because certainly as a retail investor, personally, I'm relying on the skill sets of either an asset manager to select a stock, or I'm relying on the skill sets of an index provider to use research to construct an index that's using meaningful data. So already, there might be a price to pay for a subscription, but that's helping contribute to better investment decisions. And if we then think about that, what do you have if you don't have better investment decisions or well-informed investment decisions, right? Yeah. You could make a decision that loses a lot of money.
Yes.
And so, in fact, the cost of the subscription of the data, it could be very small relative to the loss that you make in a multi-million-dollar investment that's not taking into account all of the aspects of the company that you're investing in.
If I was to say that the assumption is correct, and I'm saying this as a certain way to, I guess, communicate to our audience that I understand where some of our audience might be coming from here with a healthy dose of cynicism. So if there was a cynical view on ESG, then that probably doesn't get fleshed out in a very scientific way because it's already on the defensive, right? Or on the offensive, depending on which side of the fence you look at. The timing around the assumptions, say 3 to 5 years before these risks really bite companies in the butt. If they don't do something now, we're going to be missing out. I'm sure that is based on some solid science, but so are a lot of other trends that we can look at in the investment world. And if that's wrong, we're effectively paying for something well in advance of there being an apparent win-win. And I understand that it's not just about getting a rate of return, it's a qualitative return as well, right? We want to make sure that we're investing and we're not harming the planet and effectively destroying people at the same time. That's kind of probably more important in my view. But is it really that safe to actually put your eggs in this ESG basket when there's still an element of, well, we don't know really when the fruits of this bad behavior on the planet, for example, will kick in? Yes, there's lots of data that's coming through, but can we really be that certain?
Climate change does have a sense of urgency, according to the science, of the impact of mankind's emissions on global warming, right? We've isolated it. It's been driven by the Paris alignment that we see coming from IPCC. It's why the XRB is focused on climate change in their
XRB.
reporting. So the XRB, the regulator here in New Zealand, who has come forward with mandatory reporting for the largest listed companies. It's capturing around 170 companies that will have to report on their climate change exposures aligned with some other global, and I say some other global initiatives because I want to avoid keeping the acronyms going, because I know that the audience is probably thinking, yeah, that's right. The Task Force on Climate-Related Financial Disclosure.
Yeah.
Right. The reason there's an acronym for that is because that's a mouthful. So TCFD has been the one that's been used as a reference point. It's a really important initiative. Google it, right? Get out there and Google it right now, guys, because it was published their first paper was published in June 2017. It was a game changer in helping standardize the information and the structure of how to manage climate change as a corporate. And when I say it was a game changer, it really provided that approach that was quickly adopted because of how clever it was in bringing together that information. So climate change is really important. So that's the second. The third is around what a company does, like what the actual operations are. We call it involvement. What business is that company involved in? And that tends to be the issues like alcohol, gaming, cluster munitions or weapons. We say, firearms. And some of these issues are actually legislated in New Zealand as exclusions from investments, right? So you'll see this if you Google the values-based ethical screens that come that are relevant to New Zealand, and they are ethical. It's based on the values and beliefs of investors, and they can be different. Okay. And then the fourth one is around opportunities. We haven't talked much about opportunities. You mentioned risk management before, but there's also opportunities when it comes to sustainability, because there is a new industry being developed around solving for climate change. Right. So then that might be as simple as solar panels and wind farms. It could be energy efficiency. There's multiple business opportunities.
And that's where my mind immediately goes. Well, is this a derivative of the underlying markets, right? Like there's this new realm, the sustainability realm, we'll call it for argument's sake, which is it's been put there artificially by men in our attempt to program this corporate entity to have values. Is that so far you're with me? Like, is that?
Yeah, like I kind of think of it. I think of it differently. I don't like put there means that, as a financial service provider, I've gone, this is important to you. You should pay attention, company. Or in fact, it's been demand driven, right? As society's developed, our expectations of what a company does have grown, and they've become more than just, okay, you can make a profit at any cost. Right? Oh, we don't care how many people you kill in making that profit. We don't care if you destroy communities. We don't care about the waste that you put into our waters. That's stopped. And there's so many examples that we can point to about the benefits that we see. So, being an Aussie living in Sydney, I can tell you, Sydney Harbour is so much cleaner than it was, in the past, right? So, there's an example of just how the expectations of society has led to a change in the behavior of companies. Now, this is something that's important to investors, because we want to have a planet that we can retire into comfortably, that we can live in, not just one that we have a lot of money. Because if we've got a lot of money and we can't live on the planet, if the WF is right and business as usual is making the planet unlivable, then what use is it to have a retirement? Now we have an opportunity now, and it's a wake-up call to everybody that you can make a change yourself in your daily life, but you can also drive a change in the way industry works, the way business works, by promoting those businesses, because the information's there now to identify businesses that do have greater climate resilience, that are better social, environmental, and have stronger governance behaviors.
Right.
We have that information now. We didn't have that before.
Right. Going back to what you said, though, it's demand driven. I totally agree. Like, I think that even just with my circle of friends, absolutely, everybody's a lot more focused on sustainability concerns now than they used to be. Yet when I'm talking to investors, it's almost like a manifestation of the NIMBY, not in my backyard, not in my portfolio, right? Like if I have to actually pay for it, while everybody else isn't, and putting aside returns and fees and all that sort of stuff. But why would some people do the heavy lifting when the others can get away with it type thing? So there's a little bit of that going, but maybe that's just because we're in the crux of some immense change right now. And I think people are a little bit, maybe they're suffering from change fatigue, and more and more talk of climate risk stuff kind of makes people tune out. Would that be something that you've heard?
I've got to say, when I think about that again, I think about it from a personal perspective, right?
Yeah.
So, I've got a family man. I've got 2 kids and a wife, and I've got a pension fund. When I think about those things, and I think about well, maybe even more so, the array of investment managers, the array of indices that are available, I think that there's always going to be a difference. There's always going to be, the spectrum of styles of investing that go from, let me make some really extreme examples, the style of investing that go from almost like gambling on the stock exchange, throwing your money, throwing a dart at a board, for instance, style investing, building a portfolio, through to really sophisticated. And so there's always going to be that spectrum. I think what's important is that, as an individual, myself, for example, I'm able to inform myself on what the investment management style is. And so, with that knowledge, I can then choose an investor that an investment manager or an index that does take those things into account. And because I'm in the role I'm in, I have very strong views on sustainability. So, I'd probably be heading towards those indices and solutions that did capture that information. So then it comes back to your question around, well, are they paying for something, that somebody else should be paying for? Well, it's like like anything, I suppose, you've got to make an investment in something to make a return. And by making that investment, they're distinguishing themselves or demonstrating that it is important to them in their investment process, or in their index strategy.
So, but basically what you're saying is that, well, we should, as investors, pay the cost.
Well, okay, so this is another good point. So, and it comes back to your question before, which I didn't get to. You pay the cost. Makes it sound like we're giving up something, right? It makes it sound like, okay, we're paying a bit more to get something else. I mean, it comes back to all sorts of decisions around paying for something. When and I'm totally digressing here.
That's okay.
Because one of my favorite sayings, which comes from somebody who used to work for me, and with her Italian flair, she once looked at me and she was referring to a pair of shoes, and she said, yeah, sure, I paid for these. They're nice shoes, but cheap is expensive. And I remember looking at her and going, what do you mean cheap is expensive? And her point was, if you go and buy cheap shoes, right, you might need to buy, 2 or 3 pairs because they wear out. Whereas you buy quality, that quality will last. Now, that in her case, that might have just been explaining to her husband why she bought expensive shoes.
That's exactly what I was thinking. Just got back from Naples. Of course, that's what you're going to say.
Exactly. But if we bring that to where I'm going with this as an example for investment managers, right? Yeah. That they're not just making a decision about sustainability research, they're making a decision about all sorts of research that they buy and that they bring into their investment process. And you would hope that the investment managers that you're dealing with, or the index construction, is using the best available research, because they're looking after your nest egg, right? If you're in terms of retirement. And the other factor of this is that when we look at indices that are constructed using the sustainability data, so as I said, S&P Global has a big team that construct these data sets, that gather the data, collect the data, create the data sets, because there's some really sophisticated data that we have on things like transition risk and physical risk. When we're creating those data sets, we also put them into we provide ways for people to access that information through investment vehicles called indices. The indices we construct using the research, we're not the ones who are providing the access to those indices directly, but we work with managers.
You're basically a service provider. You're providing high quality data to fund managers here in New Zealand. So
That's right.
we're not selling anything here. You're like S&P
Exactly.
sells to the fund manager, right?
Sells to the fund manager. And so, that fund manager might use an index that we've created, and they go, right, we're going to replicate that index, and we provide that as a product to an audience. And so there are examples here in New Zealand where there's climate resilience indices that are aligned to Paris that are available through certain products. Now, the point is, if you construct an index using the research, you generally have a track record, whether it's backtested or live performance, of how that index has performed. And it often gets compared to an index that doesn't have any ESG overlay. Now, there's questions about whether that's the right thing to do or not. We can talk about other benefits to an ESG index, which go beyond financial performance, because you're benefiting those companies that are doing better for people and community. Okay.
Yeah. That's a qualitative return that you can't see in the dollar sign. Yeah.
That's right. But if you're just looking at the dollar sign even, and this came out last night when I was at a conference, and I pulled up a chart which showed the Paris aligned index that we put together, and compared it to a benchmark, and that climate resilient index had greater returns than the market cap weighted index.
Assuming these are actually like for like in every regard, except for the ESG filter.
For the ESG filter.
Okay.
That's where well said. That's where I'm getting to here.
Okay.
Like for like, when you look at it, and anyone could go to S&P Global's website.
I'm a slow learner, Michael. So thanks for bearing with me here. I want to kind of, before I move on to some other questions I have here, I know that just based on some other conversations I've had with people that work in the fund management space who are using an active style versus a passive style, they'll often say that there is this pressure to be a closet indexer, or there's this pressure to almost be tracking indexes because they get punished by investors who will leave them when they inevitably go through the valleys that they have to go to before they get to the theoretical mountaintops. And what I'm basically saying is that one of the promises of active management is that they can outperform the market, but to do so, you really would have to trust them because you might suffer as a result. What I'm trying to get to is that, is there a risk that people who do choose the fund that does have an ESG filter on it, is there a risk that due to outperformance perhaps sometimes in the future, or an apparent failed promise to deliver on returns, or just too much of a negative return, is there a real risk that people that we're kind of creating a bubble here in ESG, and at some stage people will exit the ESG space and cause more harm than the good that it's trying to achieve?
Those are a reality for investments. The example I give of the outperformance, that's just one example. I'm certainly not saying that every ESG strategy built outperforms all the time.
Sure.
Right? That I want to make that clear, especially
that's good.
Especially for this audience. All right. So, just be clear on that. And certainly when we talk about investments, I tend to think about it as a long-term investment. You're choosing themes that are important to you. You're choosing an investment style. You're choosing an index that you have confidence in over the longer term.
Okay.
So through the peaks and troughs.
Sure.
I think that's probably the way to think about it. And coming back to what I said earlier, it really is. It's be informed. It's read the product disclosure statements. Right there. It's worthwhile for you to put in an hour of research to look at where your money's going, because you're making a decision that's going to affect where your money goes for a long time if you're in a pension scheme, right? So it's make that decision up front to be clear on what you're doing. An active manager might pick up a particular theme, know what that theme is, and know that sometimes the themes, like I said, these themes aren't siloed. So for instance, an ESG score, which deeply analyzes a company's behavior, their policies, procedure, and performance on multiple issues. We're collecting 1,000 data points at from the bigger companies on these sustainability assessments. Bringing all these together is part of what part of what we offer as in terms of index creation. And also part of what an active manager will be including, should be in my mind, right, including in their investment decisions in order to have that deeper view
Yeah.
and due diligence on companies.
So you don't feel, though, that we're potentially creating bubbles here by, if enough people kind of jump on this bandwagon,
Yeah.
don't you think that there is that risk where, let's say, for example, there's a new bit of data that comes out in the future and everybody's hopes and dreams are crashed? Like, for example, let's be really controversial.
Yeah.
We've just discovered, maybe through the power of AI to unlock the data, everybody has access to it, and all of a sudden, hey, climate change isn't man-made. I know that's blasphemy, right? But let's just say that happens, right? Would that not bring the whole house of cards crashing down?
I know you just highlighted one of the dangers of AI.
Truth or lie?
Yeah,
We don't know. We
letting
don't know.
robots tell us what the truth is.
Yeah.
Wow, I was reading a great article from Yuval Noah Harari,
Oh,
who
right.
wrote *Sapiens*. He put that in The Economist. Fantastic view on AI and just the dangers there. So beware, good and bad.
Yeah.
But coming back to your question, I was smiling as you said that because one of the things we talk about in sustainability is, in fact, that we're working ourselves out of a job. We're going to be successful in sustainability when nobody needs to differentiate the data that we provide as sustainable data, and it just becomes part of the normal data sets that are incorporated into investment decision making. So it's not that it's a bubble and it's going away.
It's a trend that's being bedded in.
It's being embedded in. The momentum behind ESG and sustainability. In fact, let me use one example of climate change. The momentum behind climate change has increased substantially in the last 5 years, to the point now where it's beyond just a demand driven by a few people or an investment management theme. It's now part of what regulators are looking at, what stock exchanges are looking at, what countries are looking at and commit to. I mean, think about it. How many countries do you know, and this is a question for you and the audience, that have a net zero commitment, right?
Mm-hmm.
There's a few. Think about what a net zero commitment means for a country. Companies make up a large part of a country's carbon footprint. So whether companies realize it today or not, that net zero commitment has an impact on them and their operations.
Mm.
And so this isn't something that's being driven by one stakeholder. And by stakeholder, for those, just to make that clear, a stakeholder is anyone internal or external that has an interaction with a company.
Thanks. Yeah.
Right. So shareholders, banks, customers. The focus on climate change and sustainability is coming from more than one stakeholder. It's coming from a broad range of people. The momentum has grown to the point where, instead of this being a bubble that's going away, I think more the concern for my future is that sustainability becomes completely integrated, and we don't need to talk about it as a separate side dish. It's part of the main course.
Sure. So really what we're in right now is a phase of bedding in where there's going to be some disruption, some cynicism, some resistance. And that came out in I was reading an article from the World Economic Forum, I think it was the beginning of this year, talking about inflation, Russia, and pockets of populism, I think was the phrase they use, as resistance to this trend towards sustainability. Do you feel like it's just an issue, it's just a matter of time before the resistance kind of falls away? It's inevitable.
Yeah, look, is it a resistance or is it a reality? Is it a pendulum swinging too far from one side to the other and we're resetting? These are all things that we discuss. And again, it was part of our key themes that will drive the ESG agenda for 2023. We looked at issues like inflation, like interest rates, like unemployment. All of these things are being brought together, and I think that to me sums up the idea that sustainability is not a separate discussion to be had. And we used to say, like, it's not a side plate to your meal. It is part of the main course, and all of these things are important as well to that discussion. We need to think about sustainability as an important issue that needs to be dealt with alongside all of these other macro economic issues.
Yeah. Okay, cool. Let's talk about greenwashing, because the Financial Markets Authority here in New Zealand, even just this week, has come out again making some comments around this. And I think almost over 3 years ago, they were effectively highlighting this concern they have, and they issued some guidance. And now I'm hearing phrases like the time for talk is over. And that signals that, and they will start making an example. I remember watching ads, and I know in one case they spent $200,000 on a marketing campaign in the 80s to do a $5,000 benefit for the environment, right? That's a classic case of greenwashing. So in your words, what would you define greenwashing as?
Greenwashing is simply misrepresenting what you do as a company, as an investor. The same as if you as an individual. And again, I bring this back to the individual so that people can really relate to it. If you essentially misrepresent what you do, you might say, I recycle my rubbish and I have a compost heap out the back.
Yeah.
Right? If you don't actually have those things, or if maybe you only recycle aluminium cans and not your glass bottles, then you've made a broad brush statement that people could misrepresent. The same is true for companies. Companies should be saying what they do and not misrepresenting it. I like the concept of what's on the can, what's on the label should be what's in the can. So I don't think that greenwashing is necessarily mischievous or intentional in many cases. So I'm painting the world in rose-colored glasses here. The way I'm going down here is that the companies need to be very clear, and investors need to be very clear about what they're doing. Now, why wouldn't they have been clear? Maybe there's a couple of reasons. If I put myself in the on the side of people who are making these claims, again, maybe they didn't realize. They didn't realize when they said that they're no tobacco or tobacco exclusion, that in fact that could make investors think that you're excluding production as well as retail, as well as licensing, as well as supplying. And that view could mean that you have zero tolerance to all those things. Now, there might be a stage where companies or investors are only doing part of those things, and yet they've made a claim we're tobacco free. So this is the nuance. We're getting right into the nitty gritty now, and this is part of what is important: clarity and transparency around what's happening. And that's partly because the consumer's smarter, investors are smarter. They want to know this detail. And then there's the other end of the scale where on the very bad side, where companies have just made claims because they think it's going to be better benefit their brand and be commercially help them. Now, in those cases where they're totally misrepresenting what they do, I think this focus on greenwashing is good, because it's helping reset the scale. The pendulum swung too far, and you had a number of people who might have felt that they could benefit from without having to actually do anything. Now, the having do anything is a really important part. That's where S&P Global plays a role. Okay, because we provide the data and analytics and the signals to help substantiate what companies are saying.
Sure. So in other words, it doesn't need to rely on your own potentially set of subjective rules that you try to follow. You're just subscribing to a set. Is that correct?
Yeah. So you're subscribing to a set. You're quantifying what you're doing. You're able to point to data analytics, to a number, to a metric that represents what you're saying or stating, I should say, in your advertisements.
Yes.
That helps support what you're doing, and then as I say, then it's also important to be really clear on what it is you're doing. If you're a company or if you're an investor, if you're a bank, be clear on what it is you're doing, and so that protects you from being caught out for greenwashing. Now, the biggest issue that I'm concerned about, more so than greenwashing, is what is now being called green hushing, which is where companies are not saying what they're doing in sustainability efforts because they're so concerned about being called out. What I mean to say is that upsets me more than anything else, because the focus is on people sharing what they do, because in
Sure.
sharing what they do,
There's leadership.
there's leadership. It helps bring people along. There's that, we can do that. This is achievable. So
Yeah.
from your example to large companies, the message is, to substantiate what you're doing,
Yeah.
be clear on what you're doing, quantify it with credible, trustworthy, third-party sources of
Yeah.
analysis, and be confident in what you're saying, because it's really important that we do continue to have the leadership,
Yeah.
and that's supported by transparency.
Yeah. Okay. Well, that's cool. So you mentioned that you're here in New Zealand. What are you up to here in New Zealand at the moment? You spoke at a conference, I think, yesterday.
Yeah, I spoke at a conference yesterday. So really, it's around education.
Yeah.
It's around, in my view, it's around sharing that. Look, okay, there's a focus in New Zealand on climate reporting, climate change reporting. So
Yeah.
this is one of the first countries in the world to have mandatory reporting, and from my experience, I'm saying to people, well, look, there are positives of having leadership in this area, because it's putting you on the global radar. It's providing that transparency. It's providing some standardization around the expected reporting, which is helping in terms of comparability for financial institutions that are looking at these companies. And also the message is that, well, it seems to be new here, and it seems to be new because New Zealand's one of the first countries that's doing this. It's not actually new in terms of the work that S&P Global's been
That's
doing.
right. Yeah. It's been around for ages.
Yeah, that's right. We've been doing carbon footprints on companies, as I said, for more than 20 years with the work from TrueCost. And the analysis that we've been doing that's aligned with TCFD, remember that acronym from earlier on?
Task Force on Climate-Related Disclosures. Is that right?
That's right. Yeah. Well done.
Getting there.
You took that away from this.
Yeah.
So the analysis that we've been doing on that since it was released in 2017 is largely aligned to what the XRB, to what the regulator here has put out to the market. So it's don't look at it as a mountain that's unclimbable if you're a company that's in the reporting or a financial institution, and be confident that that there's the experience in the marketplace to help you through these steps. It might be new to you, right? It might be something you haven't done before. There's always a little bit of anxiety around that, but seek expert advice when you're looking to do this, and be confident that it can be done.
Yeah.
And that there's help there for you.
Okay. Well, that's fantastic. Thank you, Michael. Now there's just two more questions I want to ask you. Well, one more question, I think it is. The sustainability piece, what we've been talking about so far, that would work in a unipolar world, I would imagine. So on the assumption that climate change is man-made, and in 3 to 5 years, we have a looming catastrophe and we have to do something now, all that stuff, that works so long as we have, I want to say a pyramid structure, but we have a world where there is a global policeman, and that's the United States, and we're all subscribed to that financial system. This is my understanding of it. So in a world where now there's potentially at least another pole that's forming again, the BRICS nations, and I wouldn't want to say this with certainty, but it would certainly seem plausible that they might not subscribe to some of these things that we're talking about here, because maybe they don't subscribe to that set of data, or they don't believe the data. Is it a futile effort doing any of this in the new world that we're heading into? Is it inevitable? Like, should we just get bigger umbrellas?
Right. Good analogy. Yeah. Bigger, stronger umbrellas to sustain the hurricane winds as well. And maybe move your house from the coast. So all these issues that might deal with climate change. So again, a couple of things come to my mind there. One is, we need to focus on climate change as one of the areas of sustainability, but we also need to focus on the overall sustainable profile of a company, because the overall sustainable profile of a company affects everyone, or every company, I should say, in that we need companies to be responsible for their behavior. We need them. We benefit from companies that have responsible activity over their waste management, over their operations, and that might include tailing dams. Again, I'm thinking chemicals. I'm thinking, the impact on local communities. Those are issues that they feel as much in Brazil as they do in Australia, as they do here in New Zealand. So these are issues that are felt everywhere around the world. Companies are global. They tend to, or global companies have a global investor footprint most likely, and therefore they're going to be looked at through that stakeholder lens of, we'll invest in you, but we don't want to invest in a company that has a ticking time bomb when it comes to their environmental behavior or social issues or poor governance. And so that sustainability information is relevant to everyone. The climate change side, again, I separate it, but climate change, if you believe the science, it's going to affect everyone, everything, everywhere.
But aren't we just pushing this into the darker parts of the world, is what I'm getting at?
Yeah, into the darker parts of the world. I mean,
because obviously it's like, let's
yeah,
just assume it's
yeah.
going to be cheaper to destroy the environment and get better returns. And I'm just thinking of some parts in the world where, to hell with everything else, we're just going to try to maximize profit for the shareholders. Like, that is the reality. It's not perfect, but that is what it is. Are our efforts here kind of futile in light of that?
Some of the countries that you infer might be doing less are actually, in some ways, the countries that are most impacted by climate change. So certainly, if we look at Asia Pacific, the area that I'm very focused on, we did some analysis which looked at what's the GDP impact of climate change on these economies, and we found that, in fact, the Asia or South Asia countries are 10 times more exposed, have 10 times more negative GDP exposure than European countries. And this is what's put it on the radar of the emerging countries as much as the developed countries. And the concerns that we see for these developing economies. And we're even seeing the politics start to drive that change. And changes of government that have a greater focus on stopping the deforestation. We're seeing investment initiatives from countries where they're making enormous commitments to greening their economies and the global economy. And on a completely different angle to think about this is the focus on how to create a monetary value for forests by using those forests, by adding the value of those forests in terms of credits, and then how those credits can become valuable as part of a net zero commitment that a company has made or a country has made.
Yeah, that's a question mark still to me. Like, I still kind of look at that and I go, I get it. And I remember going back quite a few years now, I was quite skeptical with Bitcoin. I know it's a very different sort of, well, maybe not too different, but it was very hard for me to get my head around it. I was a slow learner and I was reluctant to open my mind to it. I feel really similar here. It's taking me longer though here to really get comfortable with what the data is saying and to really look at this for what it is, not with all the baggage that I'm bringing to it. And so I don't know yet if my research is over. Let's put it that way. I wouldn't necessarily say I'm going to pull out the flag and say, yeah, I'm all for team ESG and sustainability. Like, I am in principle behind those things personally, but through the investment mechanism, it just still kind of feels like it's built on a lot of assumptions that might not be correct in the future world that we're heading into. And that's what I'm talking about with this multipolar world, is that if we look at all this through a Western lens, of course, yeah, if you don't subscribe to these things, you're damaging, like Bangladesh, right? Like millions of people die from climate related issues, I would suspect, based on all the flooding they have. So they've got more to lose. But again, we're looking at that from a Western lens. Maybe those leaders don't care about that sort of stuff.
Yeah, I mean, like two examples that come to my mind. I'm trying to draw on,
Sure.
the specific examples. Look at the battery electric vehicle take up in China, enormous.
Yeah.
They set themselves targets for 2030. The last report I read, they're going to exceed those targets well before 2030 in proportion of cars that are battery electric vehicle. Look at the solar energy investments being made in India. Huge amounts of investment. Now, these are just some examples of how these countries, which might have been in your list of countries that that are a concern of not doing something, they're doing something. They're already on board in the ways that they can.
But is that just because of economic reasons rather than actually sustainability reasons?
Well, this is when it becomes great, right?
Hopefully,
when
that's right.
the sustainability reasons become economic reasons,
merge,
they merge together, and that's the way the world's heading, in my mind. In one of the examples you give about Bitcoin example, without delving into Bitcoin, I can see that sustainability is more complex than Bitcoin. So if it took you a while to get your head around Bitcoin, I think sustainability, will need some more
So it's not just
effort
me
and
then.
research.
It's not just me.
That's right. Yeah, exactly. I mean, think about it like this. When was the last time you opened up the financial statements of a company, and looked through and read every line and went through and looked at, all the bullet points that go behind it, right? These are very complex statements about how a company's performing. The same's true in my mind for sustainability. These are a very complex analysis on a company, and I think you said the word, looking into the future, and like I suppose the underlying tone there was, that it's like crystal ball gazing. I think there's more substance to the analysis that we have when we're looking at climate change, and what the scenarios are likely to be in the future. And when I say that, it's modeled on analysis that's coming from scientists who spend their lives analyzing their impacts on the world. It's complex, sure, but we take that complexity and we provide it and package it in a way that's connected to what's meaningful for the financial industry. And so, this is helping to make this very relevant analysis of what the future world could look like meaningful to a company today. And I also just want to add in the other thing when I think about looking into the future, again, that's not something that's unusual for financial institutions to do, right? This is what banks have been doing for a long time. This is what we do at S&P Global. This is what credit risk is. Credit risk is analyzing what a future risk might be. So, doing these scenario analysis is actually part and parcel of the way financial institutions work. What we're really saying is that financial scenario analysis benefits from the inclusion of understanding climate risk as well.
Yes, it's a qualitative return. It's what it's always about, right? All right. Thank you very much, Michael Salvatico.
Thank you very much, Darcy. It's been a pleasure.
Cheers. Thank you.